So, something big just happened for small business owners. The One Big Beautiful Bill Act became law in 2025. And starting with the 2026 tax year, it changes how millions of entrepreneurs expense, deduct, and grow. I'm Karan, and I like helping small business owners find every tax credit and every tax deduction they qualify for at keepmost.com. So, here's what's actually changing, who benefits, and why this bill matters more than most realize. One of the most powerful incentives in the tax code for small businesses just got restored. Starting retroactively to January 19, 2025, businesses can now again deduct 100% of the cost of eligible new and used assets in the year they're placed in service. That's machinery, equipment, vehicles, real estate. You see, under prior law, this deduction was fading and fading fast. It dropped to 60% in 2024, 40% in 2025, and was set to drop to 20% in 2026 before disappearing completely. Now, the new law stopped that decline cold and made full expensing permanent. You can now deduct it all in year one. And yes, that includes heavy vehicles, trucks, vans, SUVs with a gross vehicle weight over 6,000 pounds. If they're used more than half for business, they qualify too. And we have to talk about Section 179. It has always been the workhorse of small business tax rules, the one that lets you expense equipment right away. And now it's even stronger. The One Big Beautiful Bill Act doubles the maximum deduction limit to 2.5 million, which is up from 1.25 million. And the phase out threshold climbs to $4 million. And both will now automatically adjust for inflation. That means the rule now evolves with the economy and not against it. For context, these limits haven't seen meaningful updates in years, even as equipment prices rose sharply. So, indexing them to inflation ensures the deduction keeps its real world value. For most small and mid sized businesses, that's enough room to expense nearly every major purchase they'll make in a typical year. And since Section 179 applies to both new and used assets, it's especially valuable for businesses that purchase secondhand or refurbished equipment. It means faster write offs, more cash on hand, and more flexibility to grow. Now, one of the biggest frustrations for entrepreneurs was losing the ability to fully deduct research and development costs. Starting in 2026, domestic R&D expenses can again be deducted in full the same year they're incurred. No more spreading those costs over 5 years. And for small businesses, those with average annual receipts under 31 million, the law goes a step further. You can apply this change retroactively to 2022, 2023, and 2024. That means startups that have been capitalizing their R&D costs can amend past returns and recover cash they've already paid. If you run a pass-through business, a sole proprietorship, partnership, S Corp, or LLC, this is the one you care about. The qualified business income deduction lets many owners deduct up to 20% of their income before taxes. That was scheduled to expire in 2025. It is now permanent. Starting in 2026, the income threshold expands too. The phase out now begins at $75,000 for single filers and $150,000 for joint filers, which is up from $50,000 and $100,000. That means that more high-performing small businesses can retain their full 20% deduction even longer. And at the other end of the spectrum, the One Big Beautiful Bill Act adds a minimum $400 deduction for anyone earning at least $1,000 in qualified business income. It ensures freelancers, gig workers, and those with side hustles are part of that equation too. Okay, businesses that rely on financing finally get a relief. Until now, the deduction for business interest was calculated using EBIT, earnings before interest and taxes. That excluded depreciation and amortization, punishing companies that invest heavily in equipment and property. Starting in 2026, the One Big Beautiful Bill Act restores the EBITDA standard, earnings before interest, taxes, depreciation, and amortization. So, why does this matter? Well, because depreciation and amortization aren't cash outlays. They're accounting entries, or what people call paper losses. By including them, the formula allows a larger portion of interest to be deducted, which helps industries that use debt as a normal tool for growth. It's a direct win for any business growing through capital investment or loans. The new law doesn't just favor capital, it also rewards employers who invest in families. The childcare credit for employers increased from $150,000 to $500,000 and up to $600,000 for qualifying small businesses. That's more than triple the prior limit. It means a company that builds, operates, or partners with the childcare provider can now recover far more of that cost. So for employers, this isn't just a tax break, it's also a retention tool. With the labor participation still recovering, benefits that support working parents can directly improve hiring, stability, and reduce turnover. Expect to see more businesses offering childcare stipends or partnerships with local centers. This credit helps make that financially viable. Altogether, these provisions redefine how small businesses operate. Full expensing improves liquidity. R&D expensing accelerates innovation. A permanent QBI deduction delivers stability. EBITDA-based interest limits encourage investment, and expanded childcare credits strengthen the workforce. Together, they push billions in savings back into the real economy, into payrolls, upgrades, and hiring. Early estimates suggest the One Big Beautiful Bill Act could free up over $150 billion in small business liquidity over the next 5 years. Now, a quick word of caution here, because not every state automatically mirrors federal tax law. Some will choose to decouple from provisions like 100% bonus depreciation or the higher Section 179 limits. That means that your federal and state returns may not match. So if your business operates in multiple states, these differences can create big swings in your taxable income. You want to check this before filing. This is especially true for states like California, Pennsylvania, or New Jersey, which often diverge from federal expensing rules. If you have any questions, go ahead and leave them in the comments. Make sure you like this video and subscribe to the channel. My name is Karan, and I'll see you in the next video.